Hey guys, it's Richard. You're watching The Plain Bagel. I wanted to put out another bonus kind of light on frills video this week to talk about the current market downturn we've been experiencing over the past week, but also kind of all throughout 2022 so far. The S&P 500 is down over 10% since the beginning of the year. And I don't normally like to play the role of, financial counselor on YouTube. I do believe that financial advice needs to be done on an individual basis. But at the very least, I do appreciate that a big part of investment management is emotional management. And, to educate about investing is also to touch on that kind of area and to address these sort of scary situations and talk about what's going on and how people should, the mindset they should have going through these sorts of things. So I figured I would at least talk about the markets, what's going on, and give some perspective of the situation, because it's times like these that really test people's merit and their ability as an investor. It can really challenge people, everyday people who are just trying to achieve their financial objectives. So I think it was worth addressing. So just to talk a bit about what's going on with the markets, things have already been kind of down throughout the year so far, as we mentioned. And last week we were going through the first quarter earnings for a lot of big companies. And this week, it seemed like everything sort of crashed down. Stocks were down, cryptos were down, and it seemed like a broad-based decline in the markets. And sort of the most immediate reason that people could think of that would cause this decline was the rising interest rates in the US. On May 4th, the Federal Reserve increased its own federal funds target rate by 50 basis points, or half a percentage point, which was the highest jump it's done since the year 2000. And that's generally viewed as a damper for stock markets, but also the economy as a whole. Not only do debts get more expensive as people need to pay higher interest rates, but also, as we've talked about in the past, it draws money out of the stock market as fixed income investments, and those interest rate based investments that pay out that rate, they attract more capital. Now, interest rates do play a very important role, and they have caused many recessions in the past when that central bank is too aggressive with trying to hike its rates. And given that inflation's really high right now, the central bank has kind of expressed that it's interested in being aggressive with those interest rate hikes. But that aside, there are other factors to consider with why, some people are concerned that a recession is around the corner. On the one hand, we're still dealing with COVID-19 and the very many kind of restrictions and supply chain kinks that comes with that, with China being kind of top of mind in that area. There's also, of course, Russia's invasion of Ukraine, which has caused, a cutoff of exports from both of those countries for very important commodities around the world. Things like wheat, precious metals, oil obviously being an important one, and natural gas for Europe, which has led to, that supply side inflation for a lot of European countries, as well as even here in North America for certain things. And because of the high inflation, that's not only tied to the supply chain kinks, but also to that incredible, unprecedented monetary stimulus we had during the pandemic. With that inflation, governments are starting to try and reel back their spending, also because their debt is now becoming more expensive. And with those supports being taken away, that's obviously going to play an important role for the economy moving forward. And in addition to rising interest rates, which will be a very important variable for these economies, there is another very important, monetary policy that will be coming into effect as we come out of the pandemic and the resulting lockdowns. And that is the quantitative tightening. You might have seen that the Federal Reserve has kind of outlined plans to start its unwinding of its balance sheet. And while I will put out a video on quantitative tightening if there is interest in that subject, and you can let me know if that's something you'd like to see, all you need to know for the purpose of this video is that during the pandemic, we had quantitative easing, where the central bank went out and bought assets from the market, namely treasury bonds, mortgage-backed securities, and corporate bonds. So they were directly supporting these markets, making capital easier to access for these different parties. And now, as we enter quantitative tightening, it's essentially the reversing of that. So what that means is that the Federal Reserve will go from being one of the biggest buyers in the market to one of the biggest sellers as they unwind their balance sheet. And with just under $9 trillion of assets, trillion with a T as in, the size of countries, that's going to be a selling pressure. And all these variables combined, do increase the probability of a recession, all else held constant. So that's at a high level why there's been this sort of broad-based sell-off in multiple markets. People are concerned that we're having a global recession. And, the US even recently reported its first kind of contractionary quarter this, beginning of 2022, which is one half of the way towards a recession. And that's kind of the big concern right now. During the pandemic, we had this sort of flash recession that was quickly, dealt with unprecedented stimulus from governments and central banks. And now many people are worrying that we're finally going to pay for the recession we didn't fully experience back then, as we're still, dealing with lockdowns and, economies get over what has been one of the biggest impacts to global supply chains that we've seen in the modern age. Which is why now we're starting to see more YouTube videos and headlines talking about the coming global recession. Although we've kind of had people saying that for the past decade, but it is acting up a bit. But one of the main things I want to highlight with all this is a very, kind of basic piece of information that most people are aware of. And that's, obviously that the economy and the stock market are two separate things and they measure different things. And what that means is that a stock crash is not itself indicative of a recession and vice versa. They certainly are related in that a recession can cause a stock crash. It does impact profitability as consumers pull back spending, and investors who need capital might, have to sell their positions, and that can apply downwards pressure. So the two certainly aren't mutually exclusive. But just because we've had this downturn in the stock market and many markets, over the past few days, for example, it doesn't itself mean that we're about to experience a recession. You might have noticed that the companies that fell the most over this past, earnings cycle, if you will, are the ones that had very stretched valuations and were growthier firms. Over the past earnings cycle, many of these companies didn't meet high investor expectations because during the pandemic, when we had all this ridiculous stimulus that was, supporting these results, these companies achieved remarkable returns and growth rates. And now that things are normalizing, we're seeing their valuations normalize. But that itself doesn't mean that we're necessarily experiencing a recession. It just means that very expensive stocks are being rationalized, as people realize that these very high growth rates aren't sustainable, into perpetuity. That's going to impact the valuation of these stocks that, if you use kind of any metric, has been very stretched over the past few years. And when you zoom out to the broader market, if you look at the S&P 500, for example, it's actually still up from its pre-pandemic level. In fact, it's achieved roughly an annual rate that's in line with its long-term average of around 10%. So yes, things have dampened a bit from their high-flying, days of 2020 and 2021. But when you zoom out, you can see that the impact, if you're someone who's investing over the long term, hasn't actually been that dramatic so far. And if you're a passive investor who invests in the broad market, these things really shouldn't be concerning you that much. You have time on your side if you're a long-term investor. And given that you're very broadly diversified, you can assume that your portfolio will grow with the general economy. And, if we're assuming that the economy will grow into the future, then you should be okay. There's not a whole lot that needs to be done there. Where things do get trickier and why, I do appreciate that some people are very stressed out right now is when you are an active investor and perhaps, let's say, you started investing through 2020 and 2021, and now your portfolio is down a big amount because of this recent correction. And here's the thing, I won't say that you shouldn't do anything with your portfolio. I do think that the time to adjust your strategy is before a market downturn occurs. You should always have a pulse on risk and your tolerance and things like that. But obviously, I don't know what you're invested in, so I can't really speak to what you should do given your financial situation. And buying the dip is great if you have faith in the companies you hold, but I don't know what you hold. So I won't kind of tell people at a broad level to buy the dip, on the risk that they own something that maybe they shouldn't buy any more of. But assuming you did the research and assuming you did a good analysis with your positions and you believe in your companies, that you hold good companies, and you're just concerned about the stock price and whether now's the time to sell and buy back in or whatever it be, I think it's really helpful to adopt the mentality of the small business owner during crazy times like these. The small business owner, if you think of someone who owns like a local business, whether it be a convenience store or whatever, these people don't have a group of investors constantly telling them what their property or their assets or their business is worth. They just go in every day and they run their business and they make money. And the value of their business to them is how much money it brings in. That business's cash flows. And they couldn't care less what other people say their business is worth if they're happy with the money they're bringing in and they're happy with what they paid for that business initially to get those recurring cash flows. Now, stock markets convince people that when you buy a business, you have to consider this other factor, which is how much other people are constantly willing to pay for the stocks that you own. But that's really not the case when you think about what you're actually doing. You're putting your money into a business just like a small business owner. And yes, certainly some things are different. You don't have to go into the convenience store and run it every day. But at the end of the day, you are owning a business. And if that business, you expect it to continue making money even through downturn, you expect it to be in a good financial situation, its debt is manageable and all these things, and you expect it to be around for the long term and to pay off as a long-term investment, then you shouldn't care if its price declines in the short term, unless you're interested in buying more of the company because you think it's a good deal. Because in the short term, there's noise. Everyone knows that the market isn't necessarily rational in the short term. There's always fluctuations. A lot of daily movement is determined by traders who don't care about intrinsic values. It's a lot of momentum and things like that. So you shouldn't let those things dictate what you believe a investment is fundamentally worth. Now, if through all this you're not sure if you did a good job with your research, or you just kind of pick stuff at a surface level and you're losing sleep or getting stressed out about this current event, I would really encourage you to reach out to a professional. I know it's not a sexy or a popular option even, especially when it comes to stock picks, and I understand the criticism there. But even from kind of an emotional management standpoint, there is a lot of benefit to having a professional there. And not all professionals are made equal, and that's important to remember. There are a lot of salespeople, disguised as people trying to help you. But at the end of the day, there are fee-only financial planners. There are portfolio managers with fiduciary duties to their clients. And if you're someone who, isn't prepared to do this sort of research and to work through this stuff by themselves, it's okay to reach out for help. And finally, if you're someone who owns crypto or NFTs, I do wish I could say kind of the same things and, the same principles of just hold long-term and stuff like that. But it's just a harder game to play with those things, right? You have profit-generating assets in the form of businesses, and then you have speculative assets. And it's not to say that, you might not see things emerge from that space and things might not have a long-term value. It's just a harder game to guess what people will care about in the future and what people will use for stores of values and things like that, just assuming that they will pay more for what you have than you paid for it, that kind of greater fool theory. I'm not a crypto enthusiast, and I'm certainly not the most educated in that space. So for sure, it's not to say that everyone should sell out of their cryptos and NFTs. It is just to say that, it is different from stocks. They are fundamentally different. It'd be like trying to put all your money into oil and just assuming that long-term you'll do well. You might not. That's, the tough thing about it. You don't know what demand will be decades from now when you approach retirement. Oh, and one more thing before I wrap up this video, kind of talking about DIY investing. When it comes to, getting your research from social media or YouTube or whatever it be, it's important to be careful out there because there are a lot of people who either aren't qualified or aren't experienced who are overconfident with their positions. And I've seen a lot of people, over the years talking about positions that were guaranteed to earn high returns, that were guaranteed to go to the moon or do very well, both in crypto and stocks. And when we have times like these, the viewers who kind of followed the recommendations are not prepared to deal with these sort of consequences. And you really do see the issue with being so reckless with these sorts of stock picks. And, when it comes to amateur research and stuff, sure, feel free to put that stuff out. But you need to talk about the risks with your viewers. You can't sell stuff as guaranteed, sources of return. There are no guarantees in the world of investments, as this past few weeks kind of demonstrates. So yeah, I'll stop there before I go too much on a tirade. It's not to say that every creator is like this. I do believe there are great creators in the finance space. It's just to say that, you should really take what you hear online with a grain of salt. You don't know how much research has gone into what these people are presenting. And a lot of people kind of exude this overconfidence with their portfolio because that's the stuff that sells on YouTube. That's the stuff that does well, not the balanced views, the stuff that's telling you what the one-way ticket to the moon, what that next big stock pick is. Even when, in the back of their mind, they might be aware of these big risks that they aren't mentioning. So anyway, consider all that as we navigate through these sort of downturns. It's not to say that you should abandon ship with your portfolio. Like I said, I don't know what you hold. I can't tell you what you should do with certain positions, but generally speaking, as I mentioned, the time to change your strategy, if you have faith in your strategy over the long term, is to change it before these sort of things happen. And if you have faith in your strategy, generally speaking, sticking to the same long-term principles will work in your favor. So I hope you found this video helpful. I know I'm kind of throwing it together last second, but I did want to address the downturn, given how emotionally charged this stuff can be. This is stressful for a lot of people, especially people who only started investing over the past 2 years. I'm hoping this video helps a little bit. Thank you for joining me today, and as always, be safe out there.